Hey, it's Mike Lynch with AmeriFirst Financial, and it's Monday. Time for your Monday morning mortgage update for the week of March the 28th. Hope everybody had a fantastic weekend. I had a great weekend. I actually played this weekend. I went up to Bandon, Oregon, did some mountain bike riding, ate some oysters, some local oysters with friends. Just had a great weekend. If you ever get up to Bandon, Oregon, and you have a mountain bike, you've got to check out their Whiskey Run trails. They're epic. So let's do a little bit of housekeeping, and then we'll get into our Monday mortgage update. I have been inviting many of you to our real estate boot camp, our first ever real estate boot camp. It's a 12-week boot camp. It's the most comprehensive real estate training that we've ever put together. And it was supposed to start today. That we had some major technical issues, and we've delayed that start to April 11th. I apologize so much for the delay. Sometimes technical issues get in the way and we can't resolve those quickly. So April 11th will be the start for our 12-week real estate boot camp. I'll send out some more information on that. You won't miss it. We're not going to put this in the ground. We're going to have it April 11th, starting Monday morning. Thank you for that. All right, so what happened last week? Let's talk about the market and what's going to affect it this week. Last week, big sell-off in mortgage-backed securities, down 160 basis points. The week before that, it was down 60 basis points. Rates are approaching 5% on a 30-year fixed. Rates are just high. We've been talking about this for quite some time. They're not going to get any better. They're only going to get worse moving forward. And we know that there's some major issues that we all have to deal with our buyers and our sellers in dealing with these rates. But the good news is everybody's in the same boat. So one of the main causes for these rates going up and the big sell-off, besides inflation and what we've been talking about, and the fact that the Fed's not buying mortgage-backed securities anymore, is this thing called quantitative tightening. And basically, the Fed has stopped investing on the front end in the mortgage-backed securities. Now they're talking about not reinvesting in mortgage-backed securities. And so this double whammy, not buying mortgage-backed securities to keep those mortgage rates down, and not reinvesting, which they call quantitative tightening, back into the mortgage-backed securities market, is really hitting it twice. And that's why we're seeing these rates sell off. Bond traders know this is not great news for short-term rates. Now, long-term, this is going to have some positive news. We'll talk about that in a sec. So what are the three things that we're looking at this week? We're looking at inflation that's causing a move in rates. Jobs is the second thing, and then the world, what's happening around the world. So let's talk about inflation. Sound like a broken record. Inflation is at record levels, high as it's ever been. The Fed target rate for inflation is 2%. Now, we are so much higher than that. They just missed the mark on this. But what we do know is the Fed didn't do anything about inflation in 2021, and now they're trying to play catch up, and boy, are they. So the Fed raised the Fed funding rate 0.25% last week. They've said that they're going to raise it another 6 times, which we have 6 more meetings this week, and they're going to raise it every single meeting because they have to raise that Fed fund rate to fight inflation, which is at record levels. CPI, the Consumer Price Index, the Producers Price Index, all came in at record numbers. And this week is one of the main key measures of inflation called the PCE. It's a personal consumption expenditure, personal consumption expenditure. And when they take out food and energy, that is above 5%. Folks, that is a record number. And if you compare it to the Fed target rate of inflation at 2% and the PCE without food and energy is at 5%, it's just bad for rates. And remember, inflation is horrible for rates because if you have $1 million in bonds and there's a 4% rate of return, but inflation is at 1%, you get a 4% yield, 4% yield, but inflation is at 1%, you get a 3% rate of return. If that $1 million in bonds is a 4% yield or a rate, and inflation is at 3%, now you get a 1% rate of return. So they'll raise that yield or raise the rate so investors get a decent return on their bonds. And as these rates go up, as inflation goes up, we're going to see rates go up, and it's just happening. Second thing that's affecting rates this week is jobs. Big jobs reports are coming out this week. The stronger the economy, the better the jobs, the worse it is for rates, because if everybody's making money and has jobs and employment's down, typically money flows out of that bond market, and that means rates go up. Now, we've seen some wage inflation. The the average wage is up, but it's not keeping up with inflation. So even though wages are up and employment is going to be down most likely this week, it's kind of good news and bad news because the dollar isn't going as far as it did because inflation's up. The third thing is the world. Russia, Ukraine continues to impact global economies. And then COVID. China just shut down another province of 26 million people, supply chain disruptions. And so the only thing that really is going to affect rates maybe in a positive way is there's some major development in the Ukraine-Russian war that is going to change direction. We don't expect that, but that really is the one possibility. But again, nobody really expects any changes this week. So we've got a late day today, really not much economic activity, but then it ramps up this week. We're probably going to see rising rates. We're locking moving forward. We've been in a locking position for quite some time, and it served our clients well. So if you have any clients that want to float or think about floating a rate, I don't recommend it. Lock them. If you need any advice on what's happening with rates or your clients do, please let me know. If you want to forward this video to somebody who can benefit from it, please do. If you have any comments, I'd love to hear them. Have a great, productive week, and we'll talk to you soon. Bye-bye.